Chatter, I believe.
Oh, okay. So
I didn't find it.
You didn't find it on Chatter?
No.
Okay. Well,
Only your very original memes.
okay.
But
I'll see if I can.
pennies.
I'll see if I can tag it somehow or
I
something.
got the number one, the worship one, but
Okay.
not the second.
I made a YouTube channel too for it.
Oh wow,
Yeah.
that's pretty cool, man.
I figured that way I can just drop the link in because it's such a pain to like upload it to the sites and stuff.
Okay, we have an event.
Thank you. Now that we have an event, please sign it. But I'm just gonna go ahead and get started. Today the agenda is we're gonna cover two companies, Sprint and United Therapeutics. I'm gonna do a little thing on put options because I feel like it's very
Half of the market today.
yeah, very relevant to what's going on. And then we're gonna talk about tax advantage strategies with Jason. So first and foremost, everybody's familiar with Sprint, wonderful company. A lot of people hate it, but they're one of the top 4 cell phone carriers in the nation. So it's them, T-Mobile, Verizon, and AT&T. Very stagnant industry. As of today, a few years back, things were a little bit more active. So going back to some of the lessons that we've learned previously in the other workshops, one of the valuation metrics that we can look at for determining whether or not we're getting a good price for the value, or that we're paying a proper price for the value to make sure that we're getting that margin of safety that we're looking for, are the PE ratios. And if you look over here, these charts are actually a year old now, but the average PE ratio over the last 17 years as of 2017 was 17. Just to give you a heads up, we're talking about Sprint right now. Sprint, the cell phone company. So this is a chart that shows the price to book value and the price to sales ratio for the trailing 12 months. This was obviously from 2017. And you can see here that the price to sales ratio was just over 1, and the price to book ratio was just under 2 as of the high point in the beginning of 2017. But back here, these are the 2 areas where I bought in really heavy into Sprint. And our price to book ratio here is below 2/3. So if we're thinking about what we discussed from our last class, that's pretty close to liquidation value. If you liquidated Sprint at that point or that point, you probably could have shut down operations, sold everything off, and made a healthy profit. And that's pretty crazy because you don't generally think that the number 3 cell phone carrier in the nation could possibly sell for less than liquidating value. And going back to some of the things we talked about in the previous workshop, this is a company that has an implicit guarantee by the government because it's a telecommunications firm. They're not going to let them go bankrupt or let their assets die out because it would have huge implications for our society if those assets were to deteriorate to a point that they were no longer useful. So you might say it's like a quasi government company because of the implicit backing and the heavy regulation. So that made it very attractive to look at because of the super low valuations and the implicit backing of the government. So a little history about why it ended up so awful and nobody wanted to buy it. A few years back, Sprint and Nextel decided to merge. Sprint was having problems keeping up, and they thought if they just merged with Nextel's network and acquired their assets, that they'd be able to stay afloat. And it turns out that they were very wrong. None of Nextel's, I don't want to say none of Nextel's network, but very little of Nextel's network was able to be integrated with Sprint's network. And in 2008, they wrote off the entire acquisition of Nextel. They said it was completely worthless, and they reflected that in their earnings. So they went from earnings of slightly negative, a few cents negative per share, to negative $11 per share. Go ahead.
So in our M&A class, we talk about the due diligence. How was this not discovered, the whole compatibility issue, or did you even see that when you kind of looked at the issue?
I think a lot of it has to do with management not being technically sound. So we talk a lot about people coming up through the ranks and being very good at a technical level, but not being very good at a management level. Well, interestingly enough, with these more technology-heavy companies, you can be a really great manager, but once you get to a certain level where you're making decisions like this, if you really don't understand the technology and how things are supposed to work on a basic level, then you're going to make really poor choices. And I think that's what happened in this scenario. And as far as like the due diligence goes and stuff, it's almost like what's easier to deal with. And so I don't think you saw a lot of lawsuits in this case because SoftBank made an acquisition shortly thereafter. So there wasn't much long-term harm to the shareholders. They suffered for a while, but when SoftBank said, hey, we're going to buy 80% of your company, that really lifted the stock price. So this kind of feeds into this timeline. SoftBank acquiring the company, they come in, they essentially appoint a new CEO, and that allows them to kind of change their strategy. Well, when they messed up the first time around, SoftBank was able to come in. And so previously you had the implicit support of the federal government because it's such a huge telecommunications company. And they had, at that time, they were number 3 as far as market share was concerned. But now you've got the explicit support of SoftBank. So you have 2 levels of support here, because SoftBank owned 80% of the company at this point in time. And then the federal government wasn't just going to let Sprint die. Or at least that's the assumption that I think myself and everybody that worked for Sprint was operating off. So when SoftBank came in, just like you're learning in mergers and acquisitions class, they developed a holding company that then created the quote-unquote new Sprint, which merged with the old Sprint. And then they had this, what ended up being an 80% ownership share in Sprint, and then you had your other investors who had roughly 30% and eventually 20% of the company as far as shares outstanding go. So if you think about what's going on in the marketplace, you only have 20% of this company that's liquid and 80% of it is owned by this larger entity, SoftBank. And that's really important when you think about the psychological impacts of what they wanted to get out of this investment, because they definitely weren't trying to lose money on this. So they went to back to the playbooks and they came up with the same old strategy. Hey, Sprint should merge with T-Mobile. Because it worked so well with Nextel. Turns out that the federal government did not like that whatsoever. They said, no, you're not allowed to merge with T-Mobile because it's going to start creating antitrust issues if we have too few competitors in the marketplace. I think they didn't want to go through the hassle of having to break apart these firms. which arguably they may still have to do, because as things stand right now, T-Mobile is wiping the floor with Sprint, Verizon, and AT&T. They're crushing it in the marketplace, just stealing market share from everybody. But this is in the future from the time that this case occurred. So after the federal government said, no, you can't do this, Sprint said, well, we're going to have to actually become a better company. We're going to actually have to spend the money to improve our network. We're going to have to buy new equipment, upgrade old equipment, and make sure that everything is happening properly. Well, just like most capital-intensive companies, which are often regulated by the government, think like energy companies and stuff like this isn't too dissimilar, because you need well-capitalized firms to make massive expenditures to stay relevant. So we had this situation when it came to Sprint where they were, quote-unquote, going broke slowly because they were spending so much of their cash that a lot of the analysts were like, you're just going to run out of cash. You can't keep doing this. And that's where SoftBank came in and kind of had an explicit support system. They did indeed make their network better. And SoftBank said, you know what, we're going to do everything we can to support Sprint and make sure that they stay solvent and make sure that they can improve their network. But people still weren't believing that. Even despite the marketing campaigns that they were working on, where they got the Verizon guy to come over to Sprint and say, hey, there's a 1% difference in performance between AT&T, Verizon, and us. So you're paying twice the amount of money for 1% better service. Doesn't make a whole lot of sense. So as it happens, people were starting to get this message that, hey, indeed, Sprint is becoming a quality provider of this service because they're pushing this much money into the equipment, into the marketing. But the analysts, being finance people like myself, could only focus on the cash burn. They said, hey, this company's going through money too fast, it's going to be insolvent. And if it's going to be insolvent, it doesn't matter how good the network is now, because creditors are going to demand their money. I saw it a different way. I saw it as if, for whatever reason, they were going to be insolvent, SoftBank would step in and inject more cash into this firm. But again, the analysts had other things in mind. So that brings me back to when I bought in, and SoftBank was talking about helping out over here, and they got this little bump up here. And then right around this area, SoftBank stepped in and said, we're going to set up a special financing entity. And what they did is they created a new company, they filled it with money, and they let Sprint borrow against that money and collateralized it with their equipment at a 0% interest rate. Which is totally legal, and it's that kind of explicit, like, well, if I own 80% of this company and I want it to do well, I'm going to create a financing vehicle to allow it to happen. And that was sort of like the beginning of the rise. There was when they started seeing that in the financials, they were like, oh my God, they're not burning through cash like we thought they were. They had a plan in place. So what ended up happening is the stock rose by just about 283% in less than 2 years. That's an incredible turnaround. And that's that double combination, that double whammy, where, I'm going to go back one slide, where you not only have an improvement in the underlying earnings and sales, but these are just valuation metrics. This is a price to book value, and this is a price to sales value. That's not the book value, and that's not the sales value. But both of those improved over that period of time as well. So not only did the underlying economics of the firm improve, i.e. the sales, the book value, but also the valuations improved with it. So you get that double bump, if you will. So that kind of brings me into the options portion that I wanted to talk about today. How do you go from having about a 200% return on your equity to making it over 500% return? And that's where your options come in. So I bought a bunch of call options here. And essentially what you're doing with the call options is you're getting a bit of leverage in there as well. You're saying that I want to contractually agree to a price at which I can buy these underlying assets in the future. And you can get away with getting a lot of outsized returns because the Black-Scholes model is explicitly bound by this assumption of a standard distribution. Whereas in the Sprint case, and in a lot of other cases, the reality suggests a bimodal distribution. So if I'm pricing based on the most likely price in the future being right where it is today, but in all actuality, I have a bimodal distribution where this thing's either going to 0 or 100, but it's definitely not staying where it's at, then options make a whole lot of sense. And you could say like a less risky way for me to play this thing would have been to buy call options and put options. Because if SoftBank didn't step in and help out, this thing could have very easily gone bankrupt. But when you're talking about buying at or below liquidation value, that kind of puts a floor underneath things. So I thought it only had one direction it could possibly go, which was up. So I just stuck with the call options. So this is a little snippet from my Excel sheet or whatever, but you can see here that you had an underlying return of about 203%, but you had a before tax return on the options of over 500%. And the reason that it does that is because you can invest a fixed amount of money and it goes up by multiples instead of just going up by percentage points because of the way that options pay off. So in this example up here, just following these numbers, the price that the stock was selling at the time was $3, but the contract on the options was 95 cents. So if the price rose above $3.95, I was basically guaranteed to make money because I could exercise the options contracts and buy those stocks for $3 a share, and I would have made money. But for every 95 cents over $3.95 that the underlying stock rises, I get 100% return. Well, it turned out that this thing went from a price of $3 a share to a price of over $9 a share. So all of a sudden, I had a multiple of over 5 because of the inherent leverage in the options contracts. Does that make sense?
Yes.
Okay.
The problem is if it goes down.
If it goes down.
0.
Yeah. And so that's actually a good point to make. And when you're dealing with options, it's very, very important to make it a small percentage. I don't think that I would ever recommend that most investors have an allocation of more than like 5% of their portfolio for options, because the risk that it can get entirely wiped out, that it can go to 0. You know that that 5% is at risk, but if you just lose 5%, that's, you might still break even on the year because the other 95% of your portfolio did well.
Mm-hmm.
You know what I'm saying?
Yeah.
So when you're dealing with options, I say make the exposure level very small. And I think that's very important. And you can still have an outsized impact on your portfolio because you have asymmetric returns. Like in this case, I used 5% of my portfolio, and I put really at risk 5% of my portfolio, but it was asymmetric in its return in that the upside was 5x. So I could make 5 times, or I could lose 1 time. So, and if you repeat that, if you can find similar situations where you can repeat that, then you can be wrong half of the time and still make a healthy amount of money. And so that's what I like to encourage is people that learn to invest and learn how to look at companies properly. If they take a small percentage of their portfolio and put it in options in a wise way, then there's no reason that they shouldn't have much better than normal returns as a result. So the next company I want to go over is United Therapeutics. This time last year, I said United Therapeutics was a company that I thought was a value investment. I still think it's a value investment, but full disclosure, I think I'm down I'm up by 0.5 percentage point as of today. So over the past year, investing in this company along the way, I am up by 0.5 percentage points. So not the best investment year to date, or in the trailing 12 months rather. But it is a unique company. They have a lot of very cool stuff going on. Keep going. All right, see ya. Again, talking about our valuations, you've got your price to earnings, price to sale, price to book value. That is one of the things that immediately attracted me to this company because I thought to myself that the valuations on this thing looked way too good to be true. This is a chart that I pulled earlier today. And as you can see here, this is a price to earnings ratio. But over the past couple of years here, that PE ratio has been, around 10 or below 10 or just above 10 the whole time. You would say a normal PE ratio on average is 17, and we've only barely brushed that for a couple months. I think it's a strong company, but it also kind of begs the question, is this a quote-unquote value trap? So a lot of times you'll see low price to earnings ratios or low price to books ratios because the value of the company is actually declining. And therefore that valuation reflects the expectation that this company has poor performance or poor economic realities in front of it. And you can see here on this earnings line here, actually I think these aren't earnings. You would have to click on those earnings. These are actually volume metrics, so I'm going to correct myself. That's not reflective of earnings. But the earnings has been stable, but it hasn't been growing. And I think that's why you had this big peak here, and then it dropped off because there were some assumptions about growth that didn't come to fruition. So here's some snippets that caught my eye, again, from valuation metrics. So back in 2017, the PE ratio was at 8.1. That's well below that 10 or 12 range that I look for a good company. As of today, it was 11.4. The price to book and price to sales ratios were pretty high. But then where they are today is still above where I think they ought to be. And that might be a tip-off that this thing isn't as good as I thought it was, and I got too hung up on the earnings ratio. Could be. But when I came down here and started looking at operating margin, net margin, return on assets, and return on equity, all of these numbers are very, very attractive. It's very rare that you find a company with strong margins like this, and to add to that, no debt. So you have a very low risk situation because it has no debt. You have very strong margins. And this is I would say pretty typical of a pharmaceutical company because you've got that patent protection. So a lot of this strong margin, no debt, or patient capital is what they call it when it comes to pharmaceutical companies, is because you can't inject the volatility there because you automatically have these things that trigger value, the patents, that when they run out, the revenue that you see from them basically drops to zero in a very short period of time. So it's their defensible competitive advantage. It's the intellectual property. And over the past year, they've been extending some intellectual properties, getting some things submitted to the FDA for approval. Their pipeline's advancing, but nothing over the past 12 months has been approved by the FDA for release. So that's put a real, I guess, chill on the stock price, if you will, despite the fact that they're still earning good money, yet selling at essentially the same price they did a year ago. So these are the 5 drugs that they have. These drugs are all for pulmonary arterial hypertension. And the active ingredient here is the treprostinil. I have no idea if I'm pronouncing that properly. There was another one. This one has a different active ingredient. And I think they licensed that one through a different company. I'm trying to remember the name of the company, but it's slipping my mind right now. Actually, it's Eli Lilly. They licensed that through Eli Lilly. So essentially, unless they get another drug on the market that's doing well, even despite the fact that their 2 newer drugs are growing like crazy, their big drug that's on the market right now is losing market share every day because the patent on it has expired. It is one of these special areas, though, of pulmonary arterial hypertension, because patients are certain to pass away. So it's not a type of drug that you can use just for like therapy for pain or something like this. This has been shown to extend the quality of life and really improve outcomes for people over the long term. So when the medical doctors go to prescribe drugs, if these drugs provide a better quality of life or a better outcome for the patient, even though there's generics coming on the market, there's still a stickiness factor there where the doctors won't move to the generics unless they absolutely have to. So that's why they haven't dropped off a cliff as far as sales go, and their sales have stayed as high as they have, is because they are providing a quality compounds that other people can't seem to manufacture something that's a near competitor, if you will. Another part of this picture is Martine Rothblatt. She is a PhD, an MD, an MBA, and a JD, if I recall correctly. So she's kind of a brainiac, if you will. And I view her as one of the key components of this company's strategic advantage, if you will. Don't know if it's durable or not, but I'm pretty sure it is because it turns out that her daughter has pulmonary arterial hypertension. She also was the founder and CEO of SiriusXM. So she's very, very intelligent, has been proven as a leader, proven as an entrepreneur, and proven as an executive. So that gives me a little bit of extra oomph as far as my decision when it comes to investing in this company. And then this is a picture of her daughter, and her daughter talking about wanting to have a pill format instead of having an injectable drug because the injectable drug hurts. And then that's when they came up with this drug. And, you know, it's a little bit hokey, but this is actually Martine spelled backwards. So if you remember, the CEO's name is Martine Rothblatt. It's kind of an ode to, like, herself, if you will. But it tells you that she's putting herself into the products, that she's putting herself into the research, and that she's really has a serious personal investment in this because these drugs affect those that are nearest and dearest to her. And a lot of CEOs, I think, don't have that level of skin in the game. So that's my take on United Therapeutics. Like I said, 0.5% in the positive for me. I'm not sure if that's a very compelling case. If you do think that it's a value investment, and because it is still selling at fairly low multiples, you might find that now's the time to buy. But if you think the market's going to fall off a cliff, like maybe I do, then you might want to wait a few days. So this goes into put options. I got a few questions about put options. Essentially, this is the payoff profile for a put option. You pay a set fee, and if the underlying asset is at that strike price that's annotated in the option or above, then you're just out the money that you paid for in that fee. It's a fixed cost. It's just like the call options. You have a fixed cost. The only difference between this payoff profile and a call option is the mirror image. You have your maximum loss, and then as the price goes down, your put option pays off. And the reverse would be true for a call option, where this would be your max loss, and then it would start paying off as the underlying asset increased in value. So how do you express this trade in the best possible way? And it turns out over the past few days that there was an amazing opportunity to use put options to make tens of thousands of dollars. They had a story about it in the Wall Street Journal. Some guy made like $20,000 like real quick in a couple days. And essentially what he did was he bought a put option right up here before the inverted VIX fell off a cliff. So quick lesson, VIX volatility index. Over the past few years, the volatility in the market has been decreasing steadily. And they created ETFs that did the mirror image. It steadily went up as the volatility went down. Essentially, they were shorting the VIX, and they were allowing you to invest in it through these ETFs. Well, recently, this ETF, this is their ticker symbol, SVXY, allowed options to start trading on that short VIX ETF. So by buying a put option on the SVXY, if this scenario happened, you'd get a massive payout. And that's exactly what happened with this guy. And to kind of put it in context, when the XIV, or the short VIX, that's VIX backwards, was selling at about 130, you could buy a put option for between $10 and $20. The XIV dropped from about 140 down to $5.84 the other day. So at $20, if you go back one slide, that would make your strike price right about here, and then $5 would be like way over here, like off the charts. And essentially, for every option that this person bought for $20, they gained another $20 for everything that it fell between 110 and 584. So that's 115 divided by 20. Somebody do that math real quick? Can you guys do that math?
It's like 5 point something.
5 point something? So very similar. 5.75. So that's actually better than my Sprint payoff. Okay?
In like 2 days.
In 2 days. That's much better than my Sprint payoff. Because my Sprint thing took like years to come to fruition. This took a couple days.
But the secret is to know when the fall is coming.
Yeah, so, and this is true. But it's just, it's a reminder that there are ways to optimize your point of view. So for like the past 6 months, maybe even 8 months, I've been talking about how the market has been overpriced. And I've been buying put options to protect my positions and selling out of some of my stocks. Well, I had this theory about what was going on in the market and I was trying to find a defensive position, I could have very easily bought one of these options, and that would have been a much better way to protect myself at a cheaper price. It would have cost me less money. The asymmetry of the trade was much bigger.
Yeah.
So less cost, more positive potential.
So how far out can you get like the puts? Like, could you have bought it like 6 months in advance for like 7 months from then, or is there like a shorter time
They have leaps on this. So a leap is a long-term equity appreciation stock. I'm trying to remember the exact acronym. Anyways, leaps are options that last more than 12 months. So you can buy, currently on this, you can buy options that expire in January 2020. Just to give you an idea.
So way out there.
Yeah. So here's a list of books. We just got 2 for today's. And then I want to pass it off to Jason. Jason's going to do a little bit on taxes, which I think is pretty cool.
Yeah.
Something a little bit more, I guess, directly applicable to everybody.
Yep, looks just like yours. Huh?
There you go. Yeah.
I may have stolen all of his pictures. Ooh. That's not normal.
On the top, there's a drop-down menu. On
Right.
the middle one. Yep. And you can switch the
Swap.
There you go.
Okay. So basically, we've talked a lot about how to make money. The problem comes somewhere along the line when you have to pay taxes on it. So today I'm going to go through the basics of tax mitigation strategies. I'm going to talk about some of those long-term investment vehicles where you can sort of hide money in a tax-managed sort of way, compare some of them, and then talk to you about some of the companies where you can get your IRAs and 401ks and that sort of thing. So everyone's afraid of the tax man. As everyone said for generations, the only thing in life that is sure is death and taxes. There is no escape, and if you escape for a while, they will find you and you'll owe interest money on it that you can't afford. All right, so let's talk about some of the basics. So most people know about the fact that there's short-term and long-term investment gains. But most people have no idea exactly what makes the difference between them and at what brackets you're actually hitting in them. In this slideshow, I'm going to have a lot of details. I'm kind of spewing you really quickly. So I have them in the notes section on the PowerPoint, and I can send that out to everyone later. But I can't include everything on the slides because it would just make your eyes water. Basically, with short-term and long-term capital gains and dividends is if you hold a stock for more than a year and you sell it, it's long-term. If you hold it for less than a year, it's short-term. Short-term means you pay ordinary income tax rates. So assuming that you make a lot of money, you might be in a very high tax bracket, they're charged at your highest tax bracket. So it could be up to 37 or 39%, which is a lot. However, capital gains and dividends tax brackets, especially for qualified dividends, are all, like the long-term side of things. You can get a situation where you max out at 20% for that, and most people are in the 15% bracket. So you're paying much, much less if you hold it for longer. This is especially true in a scenario, like if you've already held a stock for like 11 months and you're thinking about selling it, if you hold it one more month, assuming it doesn't crash to the ground and lose all your money, you hold it one more month, you can reduce your tax bill by potentially half, which is quite a lot. And some people just don't think of that when they're going through and doing it. Something to keep in mind too is federal and state taxes. So we just talked about federal taxes, okay? States also have their own taxes, usually on income. Some states don't. Florida has no state income tax. Texas has no state income tax, amongst others. So you don't necessarily have to worry about the impact here. Like in your investing here, it's not a big deal. But if you're investing in one of those states, income tax can play a role because then you have to consider when you're making the gain, for short-term gains, you're gonna have to pay that state income tax as well. And then lastly, like I'm going to talk a lot about the different kind of ways to protect your money in tax-advantaged investment vehicles. Your IRAs, your 401ks, your 403bs, your TSPs, so on and so forth and so on. So to give a little bit of a snippet about rates, it's important to understand there is a 0% rate. Very few people who are making investments fall into this bracket, but Congress thought it was a good idea to basically encourage people who are on the lower income scale to invest, okay? Almost no one takes advantage of this, okay? A really interesting thing is people, like married couples who make under that, is there like a laser on this?
That's
Yeah. So married couples making up to $77,000, which is actually a pretty large number of Americans, okay, have 0% long-term capital gains and taxes. That is an enormous boon. You owe nothing on any gains you make in there that are long-term. However, most of those people, if they do invest, they do all of their investing through like a 401k where they're going to have to owe taxes later. That's one of the rare scenarios where if you made less than $77,000 as a married couple, you'd actually probably be better off not putting money in a 401k and just investing it in your own pocket. Which sounds crazy, but it's true. Then of course you have the 15% bracket, which affects most of us. So I will send this out so you don't have to worry about taking pictures if you don't want to. Most people fall in the 15% rate. You can see here, all right, that's up to $425,000 a year for the average person. Most of us, that's going to be most of your earning years, you're going to make between 36 and 425. If you'll notice, married filed jointly, the number is hardly any different at all. That's one of those, I don't know if you've heard the marriage, basically, penalties. So if you're married, you're inherently worse off for investments in terms of like long-term capital gains tax. Like even if the married couple files separately, you're down to $239 to get this, whereas an individual would be $425.
Mm-hmm.
So it's inherently punishing to people who are married. Of course, generally the view of Congress is if you are making more than $200,000, you're deemed rich. Therefore, they don't give a flying hoot about your marriage status. None of that matters. Yes?
So these brackets are based on income, not the income that you get from the gains and dividends.
So the income you get from the gains is included in this, yes.
Okay, it's the whole.
So basically, like a sample scenario would be like if you were a single taxpayer and you made $50,000, you don't get anything in terms of like the 0% rate. Let's say you made $35,000 as a single taxpayer, right? The first $3,600 of your investment gain for long-term stuff would be tax-free. However, the second that you cracked $38,600, all that after is at the 15% rate. Okay. Now you may notice I have this weird 18.8% and 23.8% here. Like, what's going on with that? Now we've gotten to a whole other animal here. When the ACA law was passed for the American healthcare stuff, essentially a new investment tax was introduced, but only if you made greater than around $200,000 as an individual. So it ends up like creating this mid-level bracket somewhere in the middle of here, like if you get greater than like 200,000. However, it also has its own specific marriage penalty, which makes this chart like super confusing if I included all of it, so I just sort of left it on there as a little additive. But basically, if you crack around $250,000, you may be subject to an extra 3.8% on all the money above that point. So it's confusing. I wish it were a little more simple, but I was telling Phil earlier, the thing with sort of like long-term gains and investment taxes, like people always want there to be a rule of thumb and an easy way to keep track of it. And there are people online, if you read an article about this kind of stuff, they have very short blurbs about like how to avoid taxes and the best way to do the general rule of thumb. But the problem is, most of us aren't going to be average Americans. The fact that you're doing your MBA program means you're probably going to be in the top 10% of people the rest of your career. And so all this stuff is relevant to you. This will probably happen sometime during your career, particularly if you get married to someone who also has high earning potential. Then it'll probably kick you into a lot of these buckets and it will matter. So, what do we do about that? All right, there are ways to legally avoid taxes, basically. the government wanted to incentivize people to save, especially as it piecemealed and destroyed a lot of pensions across the US and reduced people's dependence on it. A lot of government pensions even are sort of falling apart, and Social Security is running out of money. We've heard on and on and on and on and on. So basically companies and government wanted to push that back onto people to invest, and they created ways where you could essentially have either tax-free earnings, or your money wasn't taxed on the end, or you had some sort of weird healthcare thing. You may notice one on here that you're not used to seeing, which is the HSA, and I will cover that at the end, but they have, whether purposely or not, created an enormous loophole which makes that a new, very interesting investment vehicle. Okay, there's a bunch of garbage in here, I know, I'm sorry, but a lot of it's relevant for us. So an IRA, a 401k, a 403b, and a TSP are modeled after each other and are supposed to be the same thing. There are little differences between them, but the main elements are the same, and you've probably heard of at least one of these. Basically, you have tax-deductible income, okay? You are not paying taxes on the money as it's being put into the investment thing, therefore it is more than it otherwise would be. If you make $100,000 and you're taxed at 30%, now those aren't actual rates, but just to give an idea, normally that means you're only receiving 70% of your money. So of, let's say, $10,000 of gross income, only $7,000, would be able to be put towards something. Whereas during this, you'd be taxed like that previous amount at 0, so you can put much more money in than you otherwise would. So you're not taxed on the money that's going in, and it counts as basically a deduction against your income and your taxes. However, when you pull the money out when you retire, you owe ordinary income tax on all of it. All the money that you pull out, the gains, everything, okay? Which sounds bad, but realistically isn't necessarily bad because you're earning gains on the part that would have otherwise been taken by the taxman. So it can be quite advantageous to do this. And I have a full breakdown later in the presentation that will give you some sort of like details between the different plans and what adds up better. Generally, it also has, you have to withdraw by 59.5 to avoid a 10% penalty. So like, you can't keep your money in here very long. So basically, you have to start taking money out at a certain point. Sorry about that. That was 70.5 for minimum distributions. That mixes up a little bit. Basically, you can't withdraw money before 59.5. So generally, it wouldn't necessarily be good for like an early retirement thing, but as you're getting closer to retirement, you're fine. But you have to keep in mind there's a penalty. So the government doesn't want you to take money out too early. And generally, if you're going to retire with this money, you probably shouldn't be withdrawing before 59 anyway. The important thing I was actually trying to mention earlier that I got a little confused on was you do have to take money out by 70.5. So when you hit 70 years old, you have to start withdrawing the money, or they will start essentially taxing it and start penalizing you for it. And I don't know all the rules around it, but there's a lot of bad things that happen. So it's not necessarily a good thing. However, there's a fun note for 401ks, which makes them somewhat more valuable for early retirees than an IRA would be, which is if you retire at between the ages of 55 and 59 from your employer, and you have a 401k, you can just start using it, and you are not subject to the penalty. So realistically, this 59.5 doesn't apply if you retire from your employer at age 55. Yes?
So does that mean that I'd have to spend 20 years with my employer? Is that what you're saying?
As long as the 401k plan is vested, you're good to go.
Oh, okay. So I can
So-
start pulling from a vested plan, even if I didn't spend 20 years there
Yeah.
at 50.
And most places vest, a lot of places vest immediately with a 401k, but the worst are probably 2 or 3 years. So some people, under rare scenarios where they retire super early, like some people retire in their 40s, they'll actually get a job when they're like 54, and then do the job to 55, retire from that job, and then it allow them to access like the 401k that you can sort of shove money in and around. Some of this you start getting into weird legal things because you can push money in and out of 401ks and IRAs and stuff like that to sort of take advantage of the ability to do different things within each of them. 401ks also have a really unique aspect where you can basically take out a loan against the 401k for up to half the value of it. So it allows you, if something happens. So a lot of times you end up trapping a lot of money within the 401k and you don't want to pay the penalty on it to have to take it out. You can actually just borrow against it and then you pay interest back to yourself. So you still owe interest on it, usually between 3 and 5%, but you're paying the interest to yourself.
How come?
So basically, they're treating it as if they're different financial entities. So you have to take out like a standard like market rate interest loan against this, but it's you, like you own both of them.
Oh.
So like out of your own cash monies, you're paying back the loan,
Okay.
but it's interest to yourself. So it sounds stupid,
Right.
but the idea behind it is just it preserves the way and the separation of the accounts.
And when you have to pay back that money?
There's different payment terms. Usually it's within a few years.
Okay.
I think some of the details are down at the bottom, and I left a couple of links that you'll be able to read, but it does get mired in really confusing details when you start getting into the one-offs. It's just, I'm trying to reinforce like the advantages of a 401k here. However, the IRA does have one very nice special bonus, which is if you were a first-time home buyer and you can prove it, you can withdraw $10,000 at no penalty from your IRA. Now it's only $2,000. This wouldn't be that valuable for people in a high price area or people in a very high income brackets anyway, so it may not be as relevant to you. But to some people, this can be an enormous deal for them being able to get a home at all. All right, so that's generally that. To give a special note, 403Bs are for government and nonprofits, so it's probably not as relevant to you guys unless one of your previous jobs was at a school or something like that. And then TSP is military, and I don't know that much about TSP. You can ask Bill about that. It just gets even more confusing. All right. Now, here's one of the most interesting ways, which is Roth IRAs and 401ks. Roth IRAs have been around for about 10 years now, 15 years. Roth 401ks have not been around very long and are really just started to be introduced. Like when I left my last company, they had just gotten a Roth 401k like the year that I left. And essentially with a Roth, it is the exact reverse of an IRA. You put money in post-tax. So it's money that you've already paid all of your income taxes on, but when you retire, you pay nothing in tax. That can be enormously valuable, especially if you feel that you're going to have to pay a much higher rate in retirement than you're paying now. And this is even more especially valuable if you're at early points in your career. So a lot of people will ask me, well, I don't know which one of these to get. And the answer is you can have more than one. You don't have to just have a 401k or an IRA or a Roth IRA. You can have all of those accounts and you can put whatever you want up to the limits in each one of them, and that way you can sort of straddle your income along lines and avoid tax penalties where you don't want them to happen. Other elements of it, Roth IRAs have income phase-outs where you're no longer allowed to participate in them at all. When you hit around $118,000, which for a lot of us is going to be somewhat soon in our careers, you are no longer allowed to fund a Roth IRA fully. And it folds down to around $135,000 when you're not allowed to fund a Roth IRA at all. However, we hit a really interesting point about backdoor conversions. So, a 401k does not have that kind of limit, and a 401k can at any time be turned into a traditional IRA. And a traditional IRA at any time can be turned into a Roth IRA, aka income phase outs mean nothing. So although the government said you may not add money to this plan, you can add money to a different plan and then just convert it twice, and now you're in the plan.
Mm-hmm.
It sounds like it's a crime. But in the recent tax law changes, it was actually enshrined in law and protected. So basically, a lot of people who make quite a lot of money, particularly in Congress, wanted to protect their ability to do just that. And it's probably one of the most heavily abused loopholes in the tax law. Other advantages of the Roth system is you have no minimum distributions at 70 and a half. So if you plan to live a long, long time, it can be helpful to have your money in there protected, and you don't have to withdraw it right away. You can keep making additions to the plan. It's also worth noting, withdrawals from a Roth IRA or 401k are much easier. So you're not subject to taxes on them because you've already paid taxes on them for contributions. However, a lot of times you will still face a penalty, although there's a whole bunch of rules about that I don't know all of, and you have to do a little more research for. And as I mentioned a little before for the backdoors, there's no income phase out for Roth 401ks. So you end up with a lot of these plans that are supposed to be the same, but they're not. And once again, I have a little bit of breakdown later. Another really interesting one.
Before you go to this,
Yeah.
so I believe, and you correct me if I'm wrong, there are some Roth IRAs that you can use for travel expenses. Does that make sense? Like there's some travel funds that you can create. Because in my mind, I don't want to wait until I'm 70 or 50 to live. Like what if I don't live that long? So is there some type of situation like this where I could be able to make withdrawals from it before then, if I need
So there's exceptions in all the IRAs and Roth IRAs for like illness-based stuff. There's not necessarily just, like, I don't want to wait that long. Sort of the idea behind the plans is that you're locking your money away, and then the government gives you a tax benefit for you properly saving for retirement so they don't have to pay you a bunch of Social Security. Generally, what most people would want to do is you wouldn't put all of your savings in these plans. So I know a couple of people who literally put all of their savings money into IRAs and locked it all up, and then didn't really have like a emergency savings plan, and that didn't work for them at all when like bad things actually happened. They had to cash out the plan, pay a bunch of taxes because it pushed them into an enormous bracket, ended up like causing huge penalties and stuff like that. So most people, particularly if they plan to retire early, so a lot of people these days are really considering like, well, what can I do to retire at 40 or 45 or 50? Instead of doing this, you'd have money in an alternate plan that isn't one of the tax advantage plans like these and doesn't have a penalty. And I'll show you some of those plans can actually be advantageous on their own, even towards these. So you wouldn't put it in a plan like this. HSAs. Here we hit one really interesting point that wouldn't be valuable except for a few changes made in the last few years that essentially created a huge loophole. So what an HSA is a health savings account. And most of you may have heard of it, but haven't necessarily used one before. If you have a high deductible plan, or an HSA-capable healthcare plan, either through your employer or through the Obamacare Marketplace, you're eligible to start an HSA. And in an HSA, you can fund it up to around $3,500 a year or $6,500 for families. And essentially, the money goes in tax-free. You're not taxed on it when you put it in. And when you take it out, it is also not taxed, which is much better than either of the previous plans at all, because you don't have to pay any taxes on it at all. But it has a couple of major exceptions, which were the point of it in the first place, which was you must have a high deductible healthcare plan to contribute any money to it. And it can only be used for qualified healthcare expenses, theoretically. However, a loophole was added to it that any withdrawals after age 65 essentially become a 401k and it's ordinary income. So, essentially, you have a way to put money in the fund without paying taxes on it. And then, if you have any healthcare expenses, you can pull it out without paying any taxes on it and pay those off. So the idea is that you would basically put money in and then spend all that money every year. Do you have a question?
I was just going to ask you to indicate the timing of the expenses and the timing of the withdrawals.
So an interesting note about that too is you are allowed to withdraw the money for the medical expenses whenever you want after it occurs. Next week, next month, next year, next 5 years, next 10 years. You don't have to take it out. So essentially, if you want your money to keep growing tax-free, you can just do that and then take it out when you need it later and it's already earned a bunch of extra money. So it gives you a huge amount of flexibility. And you can also save up this plan until much later in life and then use that, if you wanted to retire early, you could abuse the system like this. And let's say you wanted to retire at 45, all right? Now, you're not going to be qualified for Medicare or a lot of the older people healthcare plans until much later. So chances are you're going to have a high deductible plan. And then you could essentially say, oh, I saved up a whole bunch of money in my HSA, so I can pay all of the attributable healthcare expenses during that time period, and it doesn't totally screw you as it otherwise would, and you have some tax advantages. Now, of course, that leaves a whole bunch of other concerns about long-term investing and stuff, but essentially, you can avoid a whole bunch of taxes. And this little clause right here means that there's really no penalty for having this. So I would recommend absolutely, if you have the ability to get an HSA, 100% fund your HSA all year, every year that you can. And you can invest the money in HSA just like a 401k. Like there's funds that you can pick from and ETFs and that sort of thing. So essentially from an investment perspective, it's very similar to an IRA. It's just special that you can withdraw the money anytime you want. It is worth noting.
Sorry, I have a question. So if I say had an HSA and next year I spent or I incurred $20,000 for surgery, but I didn't want to take out that $20,000 in 30 years from now, I could take out that $20,000?
So theoretically, yes. Now, of course, I don't know what kind of law changes are going to apply to HSAs.
Sure.
That rule seems kind of sketchy. That might be something that gets closed off later.
Right.
But they couldn't ding you for it because it was an open rule at the time that you made that decision. But basically, like, instead of pulling that $20,000 out to pay that, you could just keep it in there and keep earning interest on it for another 5 years, unless you really needed it.
Right, right.
You know, some people, like, they need the cash now,
Right.
and so you just take it out. One note though, if you take this money out for a non-qualified medical expense, or they audit you and determine that you pulled it out for a non-qualified medical expense, the penalty is severe. It is twice as high as the IRA penalty for early withdrawals, 20% rather than 10. So that can cause a huge loss for that. And then if you pull it out for a purpose other than qualified medical expense before you hit 65, you would also owe taxes on it, potentially up to your ordinary tax rate. So you could be hit with a bill like 55% on the money you just pulled out if you pull it out early without like carefully considering it, spending on the right thing. So here's a sheet, and this is basically for y'all's information when I send this out to everybody. There's a whole bunch of limits and a whole bunch of rules. And I basically sort of worked through these already, but they are worth noting in here. So like Roth, you see has this $5,500 limit. The thing I was talking about with the 401k is 401ks have a much, much higher limit too. So essentially, if you wanted a bunch of money in a Roth IRA, let's say you're on a low income year. So for all of us, probably right now is your low income year. If you have a bunch of money in a 401k or an IRA, this would be an excellent time to convert it to Roth, because your tax rate right now is probably as low as it will ever be your whole life. Because most people this year are earning probably, significantly less than they normally do, and you're hoping to have a job at the end earning much more than you did before. So really, if you converted right now for this tax year, you could save thousands of dollars in taxes on what you already have in there, assuming you have the cash to pay those taxes for the conversion, because you'll owe that at the end of the year.
So you can convert to a Roth even if your employer doesn't have a Roth IRA?
So basically, employers have 401ks or Roth 401ks. That's the employer-sponsored plan. IRAs and Roth IRAs are non-employer sponsored, and you can get them at any time you want. Okay. However, you can convert between a 401k and a traditional IRA. So you can turn your 401k into an IRA, but you can't turn your IRA into a 401k because a 401k is controlled by your employer. And then you could then convert that IRA into a Roth IRA. Now, when you convert it between traditional IRA and Roth, you owe taxes on it. And I know that sounds like a whole bunch of terms.
No, I got it.
But you would owe taxes on it, but if you waited until retirement, you'd owe ordinary tax on it, and I'm just gonna say your tax rate in retirement is probably gonna be a hell of a lot higher than it is now. Because we're probably gonna be a lot richer then, hopefully. One would hope. Of course, there are scenarios where you might not be, which we can discuss. So what does it all mean? Okay, like, I just spewed numbers upon numbers at you about a lot of different things, but what does it mean? So, let's say we struck gold, okay? You are much richer in retirement than you are over the average of your career. So if you have a basic normal investment account, and I made some assumptions here, assuming you put in $1,000 a month for 30 years, you have a 7% return, and you have all mutual fund investments, which is very important for these calculations, and I'll explain a little bit after that. And I'm ignoring income limits just for comparison purposes. At the end of that 30 years, you have $842,101 money to you. This is counting for tax in here, okay? So that's your base. Okay, with a 401k, assuming you've done the same thing, but you put the money into a 401k, you'd have less money. This is one of those weird scenarios where the 401k and the IRA are not to your advantage. If you're investing in things in long-term gains, you are not necessarily making money in a 401k. I don't know how many people were in financial decisions class, but early on in the class, he was making a note about how odd he thought it was that a bunch of people were putting all of their mutual funds inside their 401k instead of keeping it outside. He said that because he was assuming that you'd pay more tax in retirement, and he's right. If you have a higher tax rate in retirement, you would lose money by putting it into a 401k versus just paying the tax up front and investing in a standard brokerage account. However, Roth is just the opposite. If you expect to be richer in retirement than the average before retirement, you make a lot more money being in a Roth. These aren't even that high of like monthly amounts. Like if you're making over $100,000, you can probably will contribute much more than $1,000 a month. So these numbers will be a lot higher, and the difference just gets exacerbated. We're talking about over 100 and like 80, I guess, but about $80,000. I mean, you're looking at 10% more money. That's a lot. That's a lot of money. I mean, that could be $80, $100, even $200,000 by retirement time, which is a really significant difference for having done this Roth instead of doing a basic account, and especially versus a 401k.
So your suggestion is to move, so from our previous employment, we had a 401k, convert it to an IRA and then to a Roth.
Yeah.
And
That's
then
exactly right.
at our new job, only have a Roth 401.
So essentially, most firms don't offer a Roth 401k.
Okay.
It's limited. Very few firms offer it. It's sort of like a new age benefit thing. My view is, if you ever have a year where you're not earning a lot of money, okay, where you're in a very, very low tax income bracket, take advantage of it. Most higher income people maybe go to an accountant, and the accountant would give them tax planning advice. And as a side note, please don't construe anything in here as specific tax planning advice, and I'm not responsible for any losses or gains you make on the decisions that I'm recommending. Not getting sued today. But essentially, if you have a low income year, like you're in school, or if you're married and your spouse is in school or making very little money or has to quit their job to have a baby, or you leave your job on unpaid leave to have a child or something like that, that could be a very, very good time to convert money to Roth. You don't have to convert all of it, but basically as much as you can tolerate tax-wise, because let's say you're earning half as much, let's say you're earning zero, all right? Which means your income bracket for long-term stuff, is very, very low, and your whole income for ordinary stuff is super low, like maybe like less than 10%. If you convert a whole bunch of money, you may only be paying 10% on it, whereas in retirement you might be paying 30%. That's 20% of your money potentially. That's a lot. It can be very, very valuable. But like I mentioned for that HSA thing, HSAs are magic and they're always the best. Now, of course, this would be in the scenario that you used it all for medical expenses and there was no income caps, which is not realistic. But I just really wanted to drive home how great this HSA loophole is. It is gold. All right. Let's assume you're keeping the same lifestyle and your average tax rate during your career and your post-retirement lifestyle is the same. Okay. Basic account, about $800K. 401K, $878. Here's where the advantage is. When you even them out, the advantage folds back into a 401K. And here's where it's really important to note. If you had the exact same tax rate, a 401K and a Roth 401K or IRA are the same. So this here is what makes the difference between those accounts, and that is the main reason that you would want to choose between the accounts. If you are planning out your long-term lifestyle and you estimate that your average sort of tax rate of your career and your retirement tax rate are going to be pretty close to the same, it kind of doesn't matter what you do. Just pick one and go for it, and you're not really going to lose or gain much either way. I would say a lot of people actually end up in this scenario. A lot of people make sort of somewhere like 27 and 28 or changing rates and stuff like that. So it doesn't really specifically matter which one you pick in that scenario. And then obviously HSAs are magic. All right, here's where you screwed up. Moving in with the kids. Your tax rate after retirement is a lot less. Perhaps you lived large and spent all your money and didn't properly prepare for retirement, so there's not a lot left. Perhaps you retired real early and you guys spread that money over a long, long time period. Stuff like that. So normal account, about 728. 401k, oh boy, that's a lot more money, isn't it? So if you expect to make a lot less money in retirement, generally, when your average tax advisor and internet guy writes an article on investment saving vehicles, I don't know if you guys have ever seen them, this is always the kind of comparison they're talking about. Almost everyone has in their estimates that you have a lower post-retirement tax burden. That isn't true for all people, but it is true for a lot of people. Because a lot of people, when they quit their medium earning job, when they hit 65, they have very, very tiny amounts of money in retirement. They can't withdraw a lot. And so they end up a lot poorer than when they started. This is particularly common amongst lower income people, as you may have seen. And you end up with a scenario where a 401k and standard IRA are very advantageous. It also means that the Roth in this scenario is worse than a 401k. If you notice, it's a lot less. Still better than basic accounts, but it's a lot less than the 401k would be if you expect to make a lot less in retirement. This is also very relevant if you've ever heard of super early retirement or FIRE, which is a sort of like picking up sort of online communities, which is a plan I'm going to retire at, and they pick like 45. So super early retirement, this might be relevant to you. Because if you're retiring really, really early, chances are you're going to have to spend a lot less money as you retire than you otherwise would. And so it can be very advantageous to get a 401k or just a standard IRA if you plan to retire quite early. All right, once again, HSA's magic. All right. Now, there's a lot of different ways to open an IRA or a Roth IRA account. A lot of different companies have it. I picked here, these have like the highest consumer rankings for those accounts. Once again, as mentioned earlier, 401ks with your employer, you don't get a choice. But IRAs are separate, so you can use E-Trade, Vanguard, TD Ameritrade. I have a TD Ameritrade account for some of my stuff, and they're pretty good. But really, it's just personal preference and who you believe has the best expense ratios. So when you're in one of these accounts, they charge you usually a fee to do sort of the holding over the account. And every firm has a different rate, and it can vary wildly. Like, some firms can be up to 2%, which is crazy, and some firms are as low as 0.25%, which is quite low. But it really does vary, and certain ones have better choices. Like most of the big ones, you know, your TD Ameritrades and your Vanguards and stuff, have a bunch of choices for how to invest in your 401k, but they don't necessarily have as many as a super high cost person, but they have a lot more than like a super low cost person. I did also sort of want to mention here for a second, investing within a 401k or an IRA is much more limited than normal. So when Phil's here talking about investing in Sprint and that sort of thing, you can't do that in an IRA or 401k. You usually get a pick of like 6 to 12 funds you're allowed to pick from, and normally they're like S&P 500 base, they're like a small cap stock, large cap stock, of some sort of bond fund, a stable value fund, and then a few other choices. And then usually your company stock is one of the last choices. Don't ever do that, please. But I know people who have done that and lost their whole lives. I think like 10 or 20% of all Enron employees had 100% of their retirements in Enron stock, which is just crazy. Like they got laid off and lost their entire life. So don't put all your eggs in one basket, especially for retirement. And to build off of some of the other stuff Phil has said about retirement here, these accounts are dedicated to when you're actually old and retired. It's supposed to be when you hit your late 50s to 60s. Like, these accounts shouldn't necessarily be super risky. Like, I wouldn't have these all in international stock. A lot of people make these a little more conservative than they otherwise would, and most people will actually sort of bring down the risk as they get older. Of course, there's complexities with that, which is a whole other presentation. But this sort of gives a basic understanding of the tax strategies. If you have any questions, you're free to ask me. I know this was quite a lot of information all at once, but the details matter for this because it makes a big difference depending on your expectations for retirement.
Thank you.
Any questions?
Sorry.
Yes.
So say, in 6 months from now, we get out of here and we have questions about it, or even if we're not in the MBA program, we wouldn't.
I'm still here, just
Wouldn't
message.
know, yeah. But like, imagine we don't know you. Who do people go to for this type of?
So most people would go to their investment advisor. So most companies with their 401k, they have like a number you can call to get investment advice.
Yeah.
I don't recommend it.
So that's what I was wondering. Are they gonna? tell you
Most of
what's
them are
right?
paid on commission,
Sure.
which means they will try to sell you one of their investments while they're giving you advice. So their advice is usually not that great. And I'd also like to add a note here. When I was first in college, I had picked like a major called financial planning as opposed to like actual finance. And it's sort of like a much easier program, and you don't have to do it. But there were a lot of firms, and they hire people from literally all backgrounds in school. Like, you don't even have to graduate college to do this. So, like, there's a lot of financial advisors who have like no real formal education in finance at all, who are giving opinions as if they're 100% confident in it. There's also something called a CFP, which is a certified financial planner, and a CFP is required to act in your best interest theoretically, but most of the financial advisors don't even have that, and I don't even necessarily trust them, to be honest. I'm not very trusting of financial advisors in general because I have known too many of them.
Oh.
If I can say, I would go with a CPA, like our friend here, or a lawyer, specifically a tax lawyer, because they do have that fiduciary rule. CFPs, supposedly, but there's
They
a lot
do,
of,
but they're, yeah.
there's a lot of conflict. So the best scenario is you have somebody with a fiduciary rule that has no oversight or influence on your money.
So basically, like, a good scenario and a person to ask would be your accountant. Like, a CPA is a really good choice for this because, one, they probably already know all about it because it's a lot of tax strategies involved in it, and they also don't necessarily control your money. Like, usually your accountant isn't the one who has all your money and is manipulating it. So if they're just giving you advice to go do, they don't make money off you choosing something. So generally, like, you want to get your financial advice from someone who, one, knows what they're talking about, but two, doesn't make money depending on your decision. Because if you make money in commission based on what you're doing, they will always pick the thing that makes them the most money, whether or not it's the right choice.
And there's a lot of, in the financial advisory industry, there's a lot of people that don't get quote unquote commission, but there are incentive pays that act in a way that make it to where the firm makes more money if you invest in their products versus their competitors' products, without regard to what situation that puts you in as an individual.
Yeah, I mean, I hate to kind of, crap on those people, but like, there are a lot of people that do that, and it's considered one of the core parts of finance is basically financial sales, but a lot of those people get in such a salesmanship sort of mindset that they can't really pull themselves back to think like best interest, because everything is a sales opportunity. If you're talking to someone who works for one of the companies I listed on there, I wouldn't trust it. Like I like those companies for what they do when you know what you're buying, but everyone's really biased, and it's really hard to pick a trustworthy person. But if you want to ask me, feel free. Like, I offer up my services as taxman and CPA, and I have in a real client relationship, I have a fiduciary responsibility, and I can't give you information I know is wrong legally.
Right.
Although please don't sue me.
That's why it's educational material, not
Yes.
specific advice.
Little generic on that. Any other questions?
So, and this might be too granular,
That's
so I got my money from working here at UF. It's just they send me a statement every month. I assume it's taken somewhere. I guess it's bad on my part. I asked Phil about it one time. So when I start working, do I just kind of call them? I don't really know how it works.
You mean money in a retirement account?
To do the whole
So
if I decide-
there is someone who controls that account.
Okay.
This would be I would want to look this up before you leave. Like, that's one of those things, like, it gets more and more irritating the further removed you are from a company, because you need to know, like, the right login information for the account. If there is someone who's handling, do you know what kind of account it is?
I don't remember what it was. I assume it's a 403B.
Oh, yeah, well,
Oh,
yeah.
okay.
Mhm.
So there's someone who administers that account. Probably one of these companies.
It was, oh god, I can't remember. It's the one UF goes through, and it wasn't one of them,
Okay.
but.
There's a lot of other, there's
Mhm.
probably like 500 different companies that do that. Essentially, you can do what's called a rollover. Some places, when you leave a business, you can keep the money in their like IRA, like their 401k, 403b, TSP plan or whatever. And sometimes there's advantageous, like TSP is pretty solid for some stuff, because you have access to invest in like treasuries, which no one else can do.
Yeah.
Sure. But most people, it gets too confusing to have so many different accounts. So you can basically roll it over into an IRA or a Roth IRA. My personal non-binding advice would be, I would think your best plan, because this is probably going to be one of your low income years in your career. I would roll that money into an IRA, and then I'd roll that into a Roth IRA. And you can do those two transactions like within almost no time between them.
But I would do that with like one of those companies, not necessarily with my employer.
No,
Right.
you would. So what would happen is you would contact one of these companies and say, hey, I want to do a rollover. And they're like, oh, we are so happy to hear that. They love rollovers. There's a huge payout for them just for accepting a rollover. So they'll work with you really closely and be like, okay, you need to get this document from them. Like, we can even call them for you. And they like, bend over backwards to basically like get it, particularly if there's a decent amount of money in there. And they'll help you figure out the paperwork about how to transfer it. But I would do some research on the different things you're gonna, like the company that you end up picking. But essentially, most of them have like customer support lines or email lines or chats on the on the site about asking questions. And how do I do a rollover is like the #1 question they get, so they can 100% help you with that process. No problem.
The thing that I would check out is what the expense ratios are in the account that you have currently compared to where you're thinking about rolling it over.
Yeah.
I've never rolled anything over from my TSP because the expense ratios are better than Vanguard.
Yeah, like no one is better than TSP. I am so jealous that you can even be in that plan. What I wouldn't do being there. But expense ratios as
It's never
Dolphins
too
are.
late to join the military.
I'm all right. Yeah.
Do you know if that's a similar situation if you work for a government, a state government, have their own
Virtually
retirement
all
system?
government, nonprofits, and religious organizations have 403Bs, like almost all.
Like the retirement system, like states who actually have their own retirement, like pension,
Okay, pensions are a whole separate animal.
pay into like their actual retirement system.
Okay, so now we've reached a whole other layer of complexity. No, I can answer the question actually.
Oh, okay.
But it's just you've reached a layer of complexity. If it is trapped within a plan called a pension, if there's a word pension anywhere in there, it's not eligible for any kind of rollovers unless there's a cash out provision in your pension plan. So I worked for the railroad and I had a pension. And since I vested it, I was allowed to cash it out. When you cash out a pension plan, you are allowed to then roll it into one of these plans if you do it, I think, within 30 or 60 days without paying a penalty. So it stays in like a protected retirement-like account. But you'd have to really contact the pension people at your old place for that, because a lot of them have really arbitrary rules and stuff like that.
Maybe it's not a pension, I don't know. Massachusetts does their own retirement system where you pay into your retirement plan. Oh, a 401A?
That's similar enough. I haven't heard of a 401A, but I think it's, I can find out in like 10 seconds.
So,
Sorry, I didn't mean to turn this into my personal.
No, I mean, we don't have a lot of people in here, so I can.
my stepdad, he works for the state of Florida, and he has a similar account. I can't remember what type it is, how it's annotated, but like by some state mandate that they had a couple years ago, you have to pay in 3% at a minimum into the state plan, and he's able to I guess at a certain age roll it out. Like once he stops working or hits that retirement, he can roll it into a different company's retirement account or into a personal one if he so chooses. I think what we found was it was cheaper to leave it there.
Okay.
Just because the larger the pool of people in said retirement plan, generally speaking, the cheaper the expenses are going to be because you can distribute those expenses across a lot more people.
Okay.
It's not always the case. I mean, like if you're from Montana and you're in that retirement system, it's probably not the case.
Ooh, good.
You should have.
Yeah, you have to look into like the rules from your employer about whether or not you're vested. And then, I mean, it's possible to roll it.